Hello, ladies and gentlemen, and welcome to the program. I'm Panasenko, financial advisor with Maloney Securities, and I have a dear friend and partner of mine, Mitch Morrison. Mitch, you want to introduce yourself to the audience?
Hello, audience. Great to be with you and very excited about this show today.
Absolutely, folks. We are fortunate to have Mitch Morrison. He's on the West Coast in our California office. I'm here at Park Avenue and 42nd Street at the Lincoln Building, and we're here just to share some thoughts about our experience. And boy, we know that there's quite a few things that we would love to share with you as far as what we've been doing with our clients and what may be helpful to you, at the present stage of your lives, as far as investments, retirement planning, and things of that nature. Myself personally, I've been in the business for over 21 years, and my partner Mitch Morrison has been doing this for what, Mitch, now 31 years? Time flies so fast, right?
Yeah, actually 36 years.
Oh, 36, my fault, so God bless. Many more to come, hopefully. So Mitch, you want to share with the audience, just in a couple of words, how you got in the business, and the value that you as a financial advisor has been able to actually bring to the people. Just some general thoughts before we get into specifics.
I always had an interest in investments and really investigating investments because, prior to coming into this business, I was in the FBI and got my master's in forensic science and decided that I'd like to look into things pretty deeply. And when I looked at investments, they had fascinated me. So I wanted to get into the business of being able to offer investments to clients.
Absolutely, absolutely. In my case specifically, one of the biggest, possible ramifications, potential ramifications and actual ramifications I'm getting here is really seeing that I've been able to navigate people through many intricate aspects of financial planning, retirement planning, risk management that really contributed to the quality of their lives at the current stage and going forward. Helping them save money for the college funds for their kids. Being able to expedite the retirement. Making sure that the whole ride from point A to point B to point C has been a lot smoother, with a lot less of a downside. We know that once you take your funds out of the bank account, you have to be exposed to certain kind of volatility, some kind of risk, but it's really my job as a financial advisor to mitigate that risk as much as possible, reducing the downside and potentially increasing the upside potential. Some thoughts on your end in that respect, please, Mitch.
Well, it's so amazing today because the choices are tremendous, and being able to ascertain which areas to go into when you can invest in things like global real estate now, or energy programs, or even startup businesses in underdeveloped countries. There are many more opportunities than they've ever been for the investing public. So that is a good thing, but it also creates a bit of a problem because, what are the best? And then if you're really going to drill down to financial advisors, can we find the best in class for our investors? And that's really what I think we're all about in our company and working with Eugene. We are all on that same page, and that's really what we do.
And it's such a great point, Mitch. You pointed out completely different asset classes, completely different asset strategies that we've been able to offer to our clients, especially in the last few years, all in an effort to expand and diversify the asset allocation of our clients' portfolios, because we know, look, there's thousands and thousands of different choices, between the 401k plan, mutual funds, to age-based portfolios and the college savings plans, to target maturity portfolios. I mean, there is gazillion choices. Information is available now online. It is really how you utilize that information, how specifically you customize it, you custom tailor it to everybody's specific needs that makes a difference. You know, what the portfolio will do over the intermediate and more importantly long term, and how well we as financial advisory team will be able to help the clients, you know, achieve their goals.
Well, I think one of the things that we always have to do is coordinate.
Right.
You know, let's coordinate with what's going on in their life. I mean, there are going to be times when they are going to need to pull money, times when they're going to be able to put more money in. So coordination and talking about that and communication is so important. You can miss the opportunities if you decide to buy a car or a house or whatever at a certain time, and there's certain opportunities out there, you know, make them more money. That's where the coordination comes in and the communication. So that's a very important aspect as well.
Absolutely, Mitch, and I can't agree more with you in that respect. So again, before any recommendation is actually made, you and I, as we both know, we would normally sit down and spend, you know, a sufficient amount of time to really understand the client's needs, what the clients have done in the past, where the clients stand, you know, at the current juncture in their lives and careers, and more importantly, where they would like to be, you know, intermediate and long term in their careers. I mean, what we do actually, I like thinking, and the feedback I've been getting from our clients is really, we're not acting just as financial advisors, but more importantly as holistic, you know, life coaches, really allowing people enjoy, you know, many things in life that they would like to enjoy, you know, over time. And again, as financial advisors, that's again what we bring to the table as the main value, I feel.
I also feel that really keeping all of the clients up to speed. Recently, you've seen some television shows and some news articles where these athletes have lost significant amounts of money, and then the reason they're giving is, well, I didn't know what I owned. I didn't know what I was in. I didn't understand. I didn't understand the tax. So we have to stay totally on top of all that communication with our clients and be as transparent as possible. And that's also acting under the same auspices of being a true professional and a true expert. The investments you pick so much, it's sometimes when you pick them and how your client or investor client has a comfort level with it. So that's very important.
It is so true, Mitch. And again, it's interesting you mentioned some athletes. And again, this is just one of the categories where you're seeing some brilliant young people, you know, young athletes, you know, signing and executing multi-million-dollar contracts. And they think that they're on the top of the world. And unfortunately, you know, a lot of times they're not really dealing with a qualified financial advisory team. I mean, they would be retaining their agents for any kind of you know, financial planning, any kind of retirement and risk management advice. And the problem is right here. I mean, they are not trained as financial advisors. A lot of times those agents, they're not securities licensed people, and therefore they just can't provide, you know, what the client needs to get as far as the quality advice. And we have seen plenty of those cases where, again, you know, they blow the disc, you know, they shatter, you know, the vertebrae, you know, whatever happens. And again, themselves, the family, they're out of luck because there has been no proper financial plan, you know, executed, and there is no downside risk protection in place.
I think you're right about that experience level. You have to remember, too, that the profile is very similar. If you're handling athletes, it's very like someone who's 60 or 70 or 80 years old that you must handle totally different, or someone, you know, who's just paid off their student debts and they're trying to get it back on track. You're talking about people in their 20s that are highly compensated, and they're certain those people. But even then, if you only specialize in that segment, I don't think you have enough experience, frankly, the ups and downs that happen in the investment world. And then also, too, one of the things that I blame for the downfall is, again, they don't have that many clients. You know, these agents have perhaps 20 or 30, but in a practice like, you know, we're used to, we can have hundreds, and it's much more diversified.
It is so true, Mitch. And again, it's not just the numbers, but it's the quality. I take huge amount of pride, and I've been doing this for many, many, many years, by making a statement where, again, I put my money where the mouth is. You know, I love working very close, very closely with my clients' attorneys, with my clients' CPAs. I always invite them to get a second opinion, you know, either when it comes down to legal advice or tax advice or, you know, retirement advice to that effect. I know that, you know, we can bring, you know, other strategies that may be more appropriate to the clients. They may be more efficient, you know, from the tax standpoint. They will be able to save some costs, you know, in many, many cases. And that's the benefit of working with a team, not only as a team of financial advisors, but working so closely with, you know, other professionals, being it legal advisors or tax professionals as well, to bring the best quality, you know, plans and execute that plan for our clients.
Yes, and just being there for the client when they get their statement and they don't understand certain things, because some of these financial statements, you know, are confusing, and especially if someone's older, and you know, we need to be there for them. We need to take the time to walk them through so they understand, you know, what do they own, how much have they made, how much have they lost, you know, do they have taxable income versus non-taxable income, do they have passive income or passive losses to offset passive income, you know, things. And it's just very imperative for us to be up on all the things that are very, very important for them.
It is so true, and I really lost track of you know, the number of cases I've seen where the client would have to pay substantially higher taxes with many, many unharvested, unrealized losses that, again, should have been realized, you know, to reduce, you know, and maximize the amount of tax deductions and ultimately reduce the amount of taxes paid. And obviously, it is because of the neglect, you know, of the advisors that those clients have been dealing with, that those things have been overlooked. You know, and ultimately, again, it resulted in substantially higher tax bill that the client had to face in that respect.
Yeah, and we're not here to fight with their CPA or their tax advisor, whether it be a tax attorney or a CPA or a tax preparer, but we are here to tell them what we know and what strategies that they can utilize and what they need to talk to them
absolutely, Mitch.
About.
Yep.
You know.
Yeah, absolutely, and that's why we love doing conference calls. We love having face-to-face meetings with not only the client directly, but you know, making sure that their tax advisors and legal professionals are also present. So again, as a team, we can deliver maximum value, the best advice possible for the benefit of the client.
And I tell younger advisors who are coming up in the business, you know, education is key, but education with outreach is also key. You know, when you learn these things, able to articulate and explain some of the advantages or disadvantages that you are educating yourself to your clients. And so I tell these younger advisors, you know, don't feel shy about expressing what you know and what you've learned.
Absolutely. The information is the key, and again, sharing the information is just as crucially important, and I can't agree more in that respect, Mitch. Let's talk just a bit about, again, some basics. A lot of times we're dealing with the people, again, regardless of the age brackets, we know that today the people that are strapped with literally, you know, hundreds and hundreds of thousands of dollars in student loans and then medical school loans and then law school loans and what have you. So a lot of times, many Americans nowadays, they postpone the time when they really start investing. When they do start investing, I mean, 401k plan probably is the most commonly used instrument sponsored by the employer, especially if the employer is offering any kind of match, whatever that match may be or may not be the case. So again, would love to hear your opinion, of the benefits of the 401k plan contributions, and again, your experience of advising our clients on those types of investments.
Well, I think that there's always it's always a good plan to deleverage. I mean, to get rid of the debt to the point where you have more disposable income. And if you can do deleverage and pay off your credit cards and pay off your cars and pay off this and that, then now you can start putting those dollars away on a systematic basis. And it becomes even more imperative to deleverage in a higher interest rate. If you have a lot of debt, then you're just paying off the interest and you're not even getting into reducing the principal.
And unlike some good debt, Mitch, let me just interject for a second. The debt on those loans, on a credit card specifically, it is not tax deductible. So we know, good debt and bad debt. So, when you own your house, for example, so the interest you're paying on the mortgage is tax deductible. When you're talking about the credit card debt, student loan debt, I mean, it is definitely not tax deductible. So those are the loans that, again, are advisable to get paid off before you introduce yourself to any kind of investments, over time, right?
Well, that's correct. And, they are not buying houses, so they're not getting a mortgage deduction.
Right.
So that makes it all the more imperative to, like I said, deleverage. Now, there are tax-sheltered investments. There are deductible investments. But, those have to be very heavily scrutinized. And the write-off programs, like, for instance, the oil and gas drilling programs are still available, but time is to be very careful. We are doing a lot of drilling. The price is not going back up, and unless prices go up, I think that some of those investments are going to be riskier. There are other programs out there like the conservation, which offer a substantial write-off. But again, you have to be very careful and know what you're getting into. But the conservation easements are basically a very large charitable deduction that you can carry forward on your taxes up to 15 years against your adjustable gross income. So some people are investing in those, and they like very favorable to those for people who have higher incomes and need the deductions.
Right, but at the end of the day, Mitch, as we both know well, right, it really comes down to the specific client, the client's specific needs, the risk tolerance. I mean, you can have two clients the same age, the same tax brackets, they may be on completely different pages when it comes down to risk tolerance, for example, or the need for those funds. Some people, they would have no problem allocating those investments over, 10, 15, or 20 years. Some people, they would need those funds, say, 5 or 6 years from the date of investment to, finance some project, pay for the child's college, whatever the case may be. So it is crucially important for us as advisors to really evaluate all the client's needs and address pretty much every aspect, on the client's parameters, what the client is trying to accomplish, what kind of risk the client is willing to embrace over the course of those investments.
In the general sense, I mean, they're thing. That's why we call them investments.
Right.
Otherwise, I guess they'd be called savings.
Oh, absolutely.
Which are paying less than 1%. So we can't all sit there and accept the 1% and expect that to really keep up. I think the goal is, if you're working hard at your job and you're doing well it'd be nice to have your investments work as hard as you do, right?
Right, absolutely.
So without any investment risk, you're not going to get that hard work out of your investments.
Absolutely.
So,
and we've heard we've heard the statement so many times from different kind of clients that, hey, I just don't like dealing with any kind of risk. Reality is that, most of the people, they're forced to, expose at least some portion of their portfolio to the markets, being the stock market or the bond market or the commodities market or non-traded securities types of strategies. There's inflation out there. Inflation, whatever the number is, you can pick it up. But, when you're generating 3/4 percentage point from the bank account, I mean, it definitely does not allow you to grow, adjusted to inflation, and then tax ramifications also need to be kept in mind as well.
Yes. So, in a nutshell, let's try to invest our capital to the point where we can go into programs and areas where there is growth. We know that real estate has growth. I mean, look at the tremendous wealth that has been accumulated in rising real estate, whether it be commercial buildings or residential or even farms or even ranches. I mean, real estate, the old adage, they're not making any more of it. So it's a good area to look at. We look at the stock market, and we know that stocks go up. We've seen tremendous rise in stocks, tremendous Googles, Facebooks, whatever, over the years. But then, because there is immediate liquidity, we know that the stocks can also go down, and there's risk there. But over time, we believe if we diversify that portfolio, then we have a very good chance of making returns that are significant than just parking it in a savings account or a CD. So that's kind of, I think, where people stand today in the United States. I think a lot of it's driven by the economy, but a lot of it's just driven by the law, where you're going to put your money. And if the investable dollars are there, where else? All areas have their day, but the stock market, real estate, even laddered bonds make sense today. And there's businesses, there's we call accredited investors that can go into what's called private equity or startup businesses. And those are very attractive as well.
It is a great point you just made, Mitch, mentioning the private businesses. We know the numbers, and the numbers, they're pretty mind-boggling. If we look at the universe of all the companies out there, and we're going to immediately, right out of the gate, eliminate any company with a revenue any lower than $20 million per year. I mean, when you look at the S&P 500 index, when you look at the Russell 2000, I mean, the publicly traded companies, they comprise just about 5%, of the universe of all the companies available for investment. So the logical question is, why would you not want to be diversified in the other 95%? But the problem is that those are privately held companies. And unless the people have really, tens or hundreds of millions of dollars to invest, they cannot go to the most famous names in the private equity line of business like Blackstone, like KKR. They just absolutely shut out of the advice from those finance portfolio managers. You and I, we have been dealing with private debt and private equity type of portfolios distributed by some of the biggest names of Wall Street, for quite some time. I mean, we just came back from the due diligence meeting in Providence, Rhode Island. Before that, we're down in Louisiana and California. I mean, we do spend incredible amount of time on due diligence, exploring other choices available to the clients outside of, you know, S&P 500 and Russell 2000 indexes. And all that is done really to reduce the volatility, being able to offer to our clients low correlated or negatively correlated asset classes to really allow the portfolio enjoy smoother ride over time.
Yes. Well, you know, when it comes to due diligence, you know, it's a science and an art at the same time, but it must be done. And I remember when I first started in my manager of our office at E.F. Hutton, he said, he asked me, what are you going to recommend for your clients? And I told him about some of the research I had done on some stock offerings. And he said, have you ever visited those companies? And I said, no. And one of the companies I was looking at was Wendy's, you know, Wendy's hamburgers.
Right.
So I drove to the headquarters of Wendy's. I went into some of the stores. I saw people eating in the stores. I saw the cash registers opening up and closing, money going in and out. And that was just as revealing as looking at their balance sheets or their profit and loss and so on and so forth. So I think like we did in Rhode Island when we went to those hotels to look at those, that's really an important part. You know, any decision you're going to make is their business model solid? Is it working? And is it going forward or is it going backwards? And those are the things that I think are very important. And
you definitely want to kick tires. You definitely want to get yourself as familiar as possible. You know, when it comes down to real estate, you want to be, you know, at the properties that make part of the portfolio. You know, it's interesting you mentioned Wendy's early in your career. When I got licensed, being a rookie advisor, that was back in 1996. Boy, time does fly so fast. But I remember Boston chicken was one of the hottest things. And, you know, many advisors have been recommending. But, you know, when I checked them out, you know, I found a lot of things that I didn't like. You know, the quality of the actual chicken, you know, it was, you know, semi-raw. You know, the ham was not really, you know, up to, you know, my taste. You know, the expansion that was really spreading, you know, like a wildfire. And eventually, again, very shortly afterwards, you know, the company stock collapsed. So, I mean, it's crucially important to really go out, visit those companies, speak with the senior management, and see, you know, as much of those businesses as possible before you can deliver any sound recommendation to your clients.
Yes, absolutely.
Mitch, we definitely, you know, will continue this conversation. We appreciate everybody tuning into this program, folks. You know, hopefully you're going to be able to join us for the next segment. Thank you so much. And until soon, here's Gene Panasenko, Maloney Securities here in New York City. And this is Mr. Mitch Morrison in Irvine, California.
Nice to be with everybody, and have a great 4th of July weekend.
Happy 4th of July, everybody, folks. Thank you very much, and until soon.